Good afternoon, and thank you for joining me. My name is David Hansel with Lucern Capital for another episode of 321, three questions, 20 minutes, and one guest. I'm joined again by my business partner and chief investment officer at Lucern Capital, Frank Forte. Frank, thanks as always for joining us. Always provide some valuable insights, and I'm sure you'll do so again today. So we're going to yeah. We're going to jump right in. Today's topic is something that's very relevant, has been in the headlines for quite some time, is interest rates. So without further ado, we'll get started. Frank, do you mind sharing with everyone the relationship between interest rates and cap rates and
Yeah.
valuations are looking at a ratio of these two?
Yeah, sure. So, I mean, there's a lot of studies on this, right? And people have gone back and forth on it for years. During the entirety of my career, and most data would point to the fact that cap rates and interest rates sort of move in tandem, right? So as interest rates go up, cap rates tend to widen out. Now, there's been periods in time where that doesn't always hold true, but generally speaking, most real estate, right, is not an unlevered investment, right? Most real estate debt helps fuel returns, and real estate in and of itself is a really low return sort of business, but with leverage and appropriate use of financing, you can magnify that, and so most people do, right? So as a result, most transactions are financed with debt that is equal to or lower than your unlevered rate of return, which is your cap rate when you enter a transaction. And in that way, you get what's known as positive leverage, and you can generate more significant returns than if you didn't have leverage, right? So generally, as interest rates move up, the cost of financing, whatever asset, industrial, multifamily, office, retail, whatever that you're buying, you're going to demand a higher cap rate when you buy. And as a result, as interest rates move up, cap rates drift upward in that same pattern. Now, what can influence that not happening, right? Demand for a particular asset, maybe a certain asset has a significant amount of value that can be created. So the going in cap rate may be a little tighter than if it was fully stabilized, because there's a lot of value that can be created, which in and of itself is an interesting dynamic, right? Years ago, you would pay less because it would be a higher cap rate for a value add asset because of the inherent risk. But as a lot of money has flown into real estate over the last 10, 15 years, and it's become a more well-respected asset class for high net worth folks. And when I mean high net worth folks, I mean people who, a retail investor who previously only had access to stock market, bond market, mutual funds, et cetera. Now that you've seen a lot of that capital come in, it's sort of flipped where value add commands a little bit of a premium in pricing on a yield perspective over traditional stabilized assets, because there's upside that can be worked. So generally, as cap rates come up, what happens to valuation? Valuation comes down, and vice versa, right? It's the same math as bond math. So that's really kind of how it works. Now, this isn't a part of your question, David, but I think it's worth addressing. There's a concept called negative and positive leverage. So if you buy an asset that's $1 million and it's a 5 cap, that means it's going to throw off $50,000 a year of net operating income, right? After all of your expenses and all of your revenue, that's what's left over. Now, picture that same asset and it's levered with a 4% interest rate product. So, and maybe you're levering it at 50%. So you're borrowing 500,000 and you're investing 500,000. So now that 500,000 at 4%, right? That's $20,000 a year. We're talking about interest only of debt service payments. So now that same asset that's generating 50,000, you're paying 20,000 in interest. There's 30,000 left over, right? But you've only invested what? 500,000. So that's a 6% rate of return, which is greater than your cap rate. Conversely, if that's upside down, you're paying 6% interest on only a 5% leverage cap rate going in, you're going to be making a lower cash yield than that unlevered 5%, because it's dilutive, in fact, to the transaction and the capital stack to add debt that's at a higher rate of return than what the asset's generating. So every dollar of leverage you put on, your returns actually get worse and worse. So in that case, it would actually be better to buy the asset with cash. And that's not something we traditionally see, or is interesting to most real estate professionals, because the idea is you want to use leverage to magnify your returns for your investors and overall your return paradigm. So if you were to buy that at a 5, lever it with a 4 in the example I just did, and then add value, now you might be at the equivalent of a 6 or a 7 cap with 4% debt, and your cash yield may be in the 8 to 10% range. So that's what most real estate investors look to do. So if you could imagine that it would be unsettling to buy something that's a 5 cap with 6% debt, and hence why the market would then demand and say, no, Mr. Seller, I'd really like to pay a 6 cap for this, because at bare minimum, I'm investing it with 6% debt, and I can't be in a situation where I'm upside down. So that interplay is sort of how interest rates and cap rates dictate sales prices in the marketplace.
Great. Yeah, that was a great example and helps definitely shed some light on it and how that all works together. So let's talk about where you see interest rates going and eventually stabilizing. You know, everything's been up in the air. Last year, rates moving up, they've kind of stabilized, and there's discussions about potential rate cuts. Where do you see things going, and where's stabilization?
Yeah, so we're definitely going to see some rate cuts, right? Upcoming in the next 2 weeks when the Fed has a meeting, plus or minus, probably see 25 BIP rate cut. Maybe you see 50, depending on if there's any data that comes in right before the meeting that suggests that economy is deteriorating further than we previously thought. So you're going to see some rate cuts come and cut that Fed funds rate down. There's an interesting concept. I think a lot of people probably don't understand that outside of real estate folks, maybe some people on Wall Street, obviously, but for your average person, the Fed cutting rates doesn't necessarily mean the 10-year Treasury or the 5-year Treasury or any of these things, or the floating rate SOFR index, right, which was previously LIBOR, doesn't necessarily mean that's going to decline. Those rates are traded rates, right? So there's an open market. The Treasury market's the most liquid in the world, trillions of dollars a day trade, and those trading imbalances push the price and yield up and down, irrespectively of kind of where the Fed decides to cut. So the Fed's cut rates influence the prime rate and influence overnight bank lending rates. And there's sort of all these, it's a roll down effect. What the Fed's cutting rates does do is say to the world, hey, we think the economy is weakening, and as a result, we're going to cut rates to potentially stimulate some activity. So if you look at the 10-year Treasury in general, the idea behind the 10-year Treasury, among other things, is the proxy, right? So if someone buys it today and they lock in at 3.85 or whatever the 10 years at today, they're basically saying, I'm okay with a 3.85% yield over the next 10 years. And as a result of the 10-year Treasury and all Treasuries being a risk-free asset, theoretically, right, and we won't get into how true that is here, you're basically saying that's the bet that I'm making about the GDP, the growth of the GDP in our economy over the next 10 years. It's a proxy in a lot of ways for that. Whether it comes true at the end or not, that's how people look at it. So you have to look back at where you think the 10-year Treasury will come in, and there's a risk premium, and then there's a risk-free rate on all sorts of traded securities. Treasuries are simply a risk-free rate equation with some adder on there for time. If you look at the math of how it works, and then corporate bonds and the like have a risk premium. That's why they trade above Treasuries, because they're not risk-free assets. All of that to say, if you look back at the 10-year Treasury over a long period of time, it's hovered somewhere in the upper threes where we are now to maybe the mid fours. And I'm talking about a long-term, multi-decade average. So if you say that's the case, and we know if you're a risk-based investor, you're not investing at the cost of Treasuries, right? You're investing at the cost of Treasuries plus a spread. You'll see those rates settle somewhere, in my opinion, in the mid 5s to 6 in terms of financing rates. So what that will do is that will make it where if you buy a risky asset, theoretically, anything but a US Treasury, anything but a risk-free asset, you're going to want to look for some sort of unlevered yield in that ballpark or greater, so that you can achieve positive leverage on the entry into your investment and generate accretive cash yield relative to dilutive, right? Dilutive is what we talked about before, where every piece of leverage you put on actually lowers your returns, and accretive means you actually get a magnification effect that's positive for your deal. So I think overall, Treasuries are going to hover in that range. They could come down a little bit if we see a really big economic, kind of bump in the road, you could see treasuries go lower. But really what we've experienced over the last 5 years was pretty much, uncharted territory, unheard of. And most times through history, the treasuries were in that 4% plus or minus range. Last thing I would add is the following, which is, there are different financing products, right? And not all of them are going to trade at the same rate. So for example, let's say if you have a super affordable multifamily deal, the government is going to incentivize you through Fannie and Freddie, right, to buy something like that. And why are they going to incentivize you to buy something like that? The return paradigm is going to be much lower on that. You're going to have to keep rents capped, and there's other reasons for it. So they stimulate growth in the marketplace, and they have the ability to cut spreads even further to make it so that, let's say you have to buy an affordable base product at a 5% or 5.5% cap rate when the market's much higher, you may be able to actually finance that with them on lower interest rate, because they're going to give you incentives, because they understand otherwise the investment doesn't pencil. So there's all these trade-offs, but the market's efficient, right? And ultimately the cost of debt and cap rates, unlevered yield going in, the market through essentially, right, groupthink and the wisdom of crowds settles in on these particular rates. Is that good?
Perfect. Thank you. All right, on to our last question here. So we're actively acquiring assets right now. Can you speak to like how we're navigating financing products and, most importantly, to allow for some future flexibility?
Yeah, no, it's a great question. So obviously when you're in a transitional market, right, which we are now, where we know rates are coming down, right? So no one wants to lock in for an extraordinary amount of time, given the fact that everyone believes rates are going to come down and there'll be some pickup there relative to where they are today in terms of a lower yield and therefore more attractive financing. Whereas previously, if you locked in earlier, obviously you rode the benefit of not having an increase in rates, right? So there are some things lenders are doing now to get aggressive and win business. Some of them are flexible prepay, right? Which in the easiest way, you asked about flexibility, flexible prepay, where it could be step down prepay instead of a yield maintenance, meaning it's a 5-4-3-2-1 or 3-2-1, and that refers to the percentage of prepay on your outstanding balance at the time you sell. So if you're in year 2 and it's a 2% prepay in year 2, and you have $5 million remaining on your loan, to prepay your loan would cost $100,000 rather. And that's for you to do that calculation, determine, is this sale price worth it that I'm getting, and net, does this make sense for the deal? Or conversely, am I refinancing, and how much am I going to save, and what does my effective prepay period look like relative to an ROI of that 100,000? So if you're going to make that 100,000 back in 4 months, let's say, because your interest rate is so good relative to where you were, it may make a lot of sense for you to do that and borrow for an extended period of time, because your payback is very quick. If it's going to take you 3 years and you only have 2 years left on your investment, chances are it doesn't really make a lot of sense. So you can look at flexibility there. Another interesting thing that's really become prevalent again in the marketplace is the idea of seller financing, which happens a lot more in the industrial and commercial space, which we're heavily involved in now and have been for a while, relative to the multifamily space. So you almost never see anything like that go on. It's very rare. But with an industrial and commercial, it's more prevalent. And the seller of these properties generally understands and knows that you need an above average financing package to get the deal done. And that's why they offer seller financing. It's not out of the goodness of their heart. It's out of the fact that they know if you take this to the open market for whatever reason, lease roll, vacancy, etc., it's going to be challenging to get financed. So they say, Mr. Buyer, I'm going to provide a financing package for you. And it's above market terms usually, meaning it's beneficial to us, right, as a buyer. So in that case, those financing packages would usually come with limited to no prepayment penalty and limited scope. And it provides you the most flexibility to turn the asset around, get it to a place that makes sense, and then ultimately refinance or sell it. So, when the market gets funky, people get creative and figure it out. Lenders still need to lend, right? At the end of the day, lenders are in the business of, borrowing low and, lending high, right? And making that spread, or borrowing short-term and lending on long-term duration. It's all, a bunch of sides of the same coin. So they have to put out money. So they're going to get creative and try to figure out how they win business. And one of the ways you win business in this environment is not jamming, borrowers into long-term paper that we know is going to be an above average yield to the bank, but it's going to ultimately hurt the buyer, sponsor, and borrower, and perhaps maybe it's bad enough taste in their mouth where they won't come back to you and borrow. And lenders like annuitized customers because it's easy, they've underwritten them, and it's a pathway to more volume. So I think that's kind of what you're seeing in the market today. And I'm sure there's some things I haven't touched on, but you're seeing people generally get creative on every side of the table to make a deal, and they're incorporating more flexibility into this. So you look for the stuff that affords you the most favorable terms given whatever your particular deal situation is.
Yeah, that's great. Yeah, so obviously deal by deal, I like to say all the time, every deal is its own fingerprint, and
That's right.
sizing up the debt to that and the business plan and aligning the strategy with that business plan is always important. So Frank, want to thank you again for
Thank you.
joining us, and
Appreciate
for
it.
everyone that has come on to watch or will be watching. Stay tuned for some more info as the months go by. Thank you, and have a
Thank you
great
so much. Bye. Thank you, David.